Okay, so I think we can get started. Welcome everyone for joining us this morning. Our presentation this morning is going to be navigating the SBA's new Paycheck Protection Program loan forgiveness application and professional services. This is the second in an ongoing series of presentations we're giving on the PPP loan forgiveness application. We have several more over the next couple of days, which you'll see in a slide shortly on your screen. But by way of introducing our two speakers, the first is Judy Barnhart. She's a Senior Vice President at CBM, and she's, in addition to being the Director of our Professional Services practice, she's very much involved in our financial planning practice as well. And our second speaker is Pat Drolet. She's an Executive President and the Chair of CBM's board, and she is also the former Chair of CBM's Professional Services practice. So they'll be taking you through an hour-long presentation. I'd also like to thank those of you who submitted your questions ahead of time. Those have been submitted to our presenters, and they've already integrated answers throughout the presentation. But if you are a first-timer to our events, you'll also notice a little chat box at the left side of the screen. Throughout the presentation, if questions do come up, please feel free to leave your questions there, and we'll do the best we can to get to all the questions. For those of you that are on the phone, we'll also try to articulate the questions that come in on the chat, so you'll have an opportunity to hear as well. We will be making the presentation slides available to everyone who's participating today. And then as a courtesy to the presenters, I would also ask everyone to mute themselves throughout the presentation. And with that, I think I'm going to turn it over to our speakers. Thank you once again for joining us.
Thanks, Joe. It's Judy. Hi, everybody. Welcome to our presentation. I do want to reiterate we do have the questions that were submitted, and we are going to get to them early in the presentation. Pat and I are going to be kind of jumping in and talking together, and each of us is also going to be trying to respond to some of the questions that come up through the chat box. So our goal is absolutely to try to answer your questions. This is going to be an informative seminar for you, and we want you to be able to leave with the resources that you need to help you complete the forgiveness application. First, going to direct you to the website that we have at cbm.com. There is a COVID-19 resource center there, and our client accounting services group, kudos to them. They have developed an Excel-based PPP funds tracking worksheet. It does all the math for you. It can be used for you to help complete the application, but it's also a planning tool. So you can fill it out and you can say, well, what if I do this? What if I do that? How does it affect the results of the amount of the loan that is ultimately forgiven? So I do encourage you, please, to go to our website and download and look at that worksheet. There's also a place to sign up for updates. As you may or may not know, last week the House of Representatives passed a bill overwhelmingly, I think it was 417 to 1, to basically add some extenders to the forgiveness, which Pat's going to be going over what those are. But I just looked up this morning. Mitch McConnell is actually trying to get it taken up by the Senate this week. It is a lot of companies that applied for the PPP when it became available are now up almost to their 7th or 8th week, and so it doesn't provide much time for them to be able to understand and comply with a forgiveness to maximize the amount of the loan that can be forgiven to them. So I think there's a lot of incentive, and there's bipartisan support, clearly, based on what the Congress passed, that the Senate will take something up and get that done, hopefully this week. So we will have those updates on our website. Okay, just as an overview, of course, you know that the CARES Act was originally passed March 27th. Therefore, companies were able to start applying in early April, which means, as I said, that their funds are probably up very soon, if not
And
already
Judy,
up.
I have an update on that. I
Yep.
looked it up last night, and as of May 30th, which I know we're a few days away from that, there was about 126 billion left available to still be borrowed. There had been about 4,475,000 loans dispersed to date, and the average size loan is 114,000 approximately at this time.
Good, thank you. Thank you for that update. We're going to be clarifying what can and can't be forgiven in terms of the use of the loan's proceeds. Bugs Bunny is here. He is going to have a haircut, not because we all need haircuts at the moment, but basically there's 5 haircuts that we're going to be going through. The first one, obviously, is spending. You have to spend the money in order to have it forgiven. There's the 75-25% test, which we're going to be going through, which essentially says you have to spend $3 of payroll costs for every $1 of non-payroll costs to get it forgiven. There's a full-time equivalent test, salary wage reduction test, and then if you did receive an idle advance, which the maximum amount was $10,000. I believe it was $1,000 per employee more recently. That is subtracted after you go through all the math and you get down to the actual amount of the forgiven loan. You're then going to have that idle advance subtracted from that as well. We're going to go each of these in detail, but that is the overview. In terms of this safe harbor, so when borrowers first applied for the PPP, the SBA guidance was saying that the borrowers had to assess their economic need for the loan at the time of application and certify in good faith that the loan was necessary. Now, with the news media basically publicizing that a number of public companies ended up receiving these loans, some national restaurant chains, even some considered to be well-off private schools, people were starting to get nervous as to whether or not maybe they should return the money or whether or not they were still acting within that good faith. This is very important. This certification safe harbor now says that if you received a loan less than $2 million, it's deemed to have been made in good faith. So everybody can kind of take a little bit of a sigh of relief that they have that safe harbor. The SBA, I'll just add, they may review the PPP loans of any size, but they have said that they're going to audit loans that are larger than $2 million. The next bullet is also a very important point. The CARES Act, when it was passed, it said that the loan forgiveness would not be taxable, which is great. However, the IRS, under longstanding Code Section 265, says that when you have income that is not taxable, then the related deductions are not a deduction on the tax return. So, in essence, it's not going to be a double dip where you get to have the loan forgiven and you get to take the deductions. That's not going to happen unless for some reason the very powerful Senate Finance Committee manages to decide they want to overrule the IRS. But right now that's where it stands. Okay, the loan forgiveness application was released on May 15th. It makes critical clarifications, and it includes obviously the documentation requirements that we're going to be going over today. It is form number 3508, SBA form 3508. I recommend that you definitely all download that. It's 11 pages with relatively small fonts. We had to read it multiple times. I'm sure you probably will too, but we're going to try to clarify it for you. There are worksheets associated with it. There's the Schedule A, which is a summary of the calculations, which we also are going to include in this presentation. And there's a worksheet that supports the Schedule A, which does not have to actually be returned with the application when you apply for forgiveness, but you have to go through those calculations in order to have the information that flows to the Schedule A. All right, refresher, and this is where a lot of the questions have come up heretofore. Payroll costs, capped at $100,000, that's an annual, $100,000 per employee. What's included? Salaries, wages, bonuses, tips, and gross commissions. Allowances for dismissal or separation from services. Vacation, family, medical, and sick leave. Healthcare benefits that are employer paid, along with retirement benefits that are also employer paid. So, for example, no pre-tax or post-tax employee contributions. This is just the employer side. And then state and local payroll taxes. In terms of non-payroll, these must have been in existence as of February 15th, 2020. Very important rule there. Mortgage interest, which is basically on real and personal property or personal property. So it could be that you own your building and have a mortgage on it, or it could be that you have business personal property that you're paying interest on. And this specifically would apply to maybe dentist's office, where they may lease, which would come under the rent, or they may own their dental chairs or their x-ray equipment. So those do apply as long as they were in existence as of February 15th. Rental payments, real or personal property, again, as long as the lease agreement was in effect. Utilities includes gas, water, electricity, transportation, which we'll go over to in a minute, telephone, internet, and the like.
And so, Judy, we did have a question on that. My recollection was there was a question, would the rental include a storage space? And I would say yes. If there's a lease in place, that would count as well.
Correct. Right. Agree with that. So these are questions that specifically came to us. Can you include bonuses and hazard pay? Yes. But keep in mind, you still have that $100,000 annual cap. So when we talk about calculating the 8 weeks, which we're going to go to in detail, if you annualize those 8 weeks, you can't exceed the $100,000. So it's a yes with a caveat. Can you include pay to furloughed employees? Yes. So an example of a dentist office where they weren't able to see their patients, if they hired back your employees, but they had nothing to do, they were actually at home, yes, you can include that as part of your payroll cost. Retirement payments. This is important. So if you have a match, that's pretty straightforward, because usually when you're matching somebody's contribution to like a 401k plan, that match is paid on a regular basis. But defined contribution plans are included, even defined benefit plans are included. The timing is what's key here, is you want to make sure that you make those payments within the covered period rather than sometime later in the year, or even maybe next year on the extended due date of your tax return. So, we want to recommend that you calculate what that retirement contribution would be and accelerate that payment so that you have it covering that 8-week period. What about 1099 employees? A little bit of an oxymoron, because you shouldn't have a 1099 employee. It's a contractor, but contractors are not included. The idea behind that is that contractors would be filing their own applications for PPP and forgiveness if necessary. Transportation benefits. Business, again, business leased vehicles that you can have the gas used for them. Also, I had read that you could maybe claim the standard mileage deduction as a self-employed for transportation benefits. Rent paid to an affiliated company. We're still looking for a little more definitive guidance here, but it should be, as long as it's a fair market value, arm's length transaction, you should be able to claim the rent paid to an affiliated company.
I would say there, just make sure you have a lease documenting the rent arrangement with the affiliated company. Same thing with the leased vehicles. You want to be a little careful here that the lease is in the name of the company. And so if you have a company that's taking a deduction for a lease that's in an individual's name, be a little careful there. I don't think that might be considered a little aggressive. So you want to look clearly at your leases and make sure that they're in the company name, because that will all have to be provided as documentation in the long run.
Agree. Thank you for that clarification. Draws to owners and partners. We have 2 slides that we're going to be coming up to on that. That's been a popular subject. But yes, draws to, like if you have a Schedule C, if you're an attorney and you have your own LLC, you can write draws out to yourself. Obviously, it's also subject to the $100,000. And in the case of owners, also subject to the 2019, the lesser of 2019 Schedule SE, basically your Schedule C net income. But we have two schedules that we're going to be going over that for LLC owners as well as partners. And then just to note, compensation does not include qualified sick or family leave wages for which a payroll tax credit is taken pursuant to the CARES Act. Key definitions. Average full-time equivalent is an employee that works 40 hours a week. If they work 50 hours a week, you still count them as 40 hours a week. The covered period has been 8-week period, 56 days. It begins the date that the loan is actually disbursed. The new rules have allowed an alternative payroll covered period. It's the APCP, and it's an 8-week period, 56 days. That begins on the first payroll period after the first loan disbursement is received. The APCP is only allowed for biweekly or more frequent filers, meaning it would have to be a biweekly pay system or a weekly pay system. If you have semi-monthly, you would have to use the covered period, not the alternative payroll covered period. And if you choose to use the alternative payroll covered period, you must use that for all the calculations in the application that refer to the APCP. In other words, you must be consistent with its application. How does the loan forgiveness
Hey,
work?
Judy, I'm going to interrupt a second because we have 3 questions all about the same thing, and I'll read the question out loud. Our 401k plan allows matching payments annually. Can we calculate the amount and use the PPP for matching even though we can't pay it until the end of the year? Another question is about the same thing, but their 401k is twice a year. And then the third one is the same question. And so I don't know why you wouldn't be able to pay during the 8-week period. You know, for these types of expenses, the paid and incurred generally applies for the payroll. And so we've been telling people, and there might be others talking about this outside that are different, but I know I've been telling clients that, you should pay this matching early. I've never seen a retirement plan that didn't allow you to pay early.
And in fact, the ERISA rules actually require you to submit the employee portion, and if it's a match, I would think that you would be sending those in at least on a monthly basis, if not after each payroll.
Well, some plans do allow a match. So the plan basically says we can do a match if we want. It's not required. I think in this case, I think to be safe, you'd want to make that decision now and maybe match for those 8 weeks and pay it. Because to hold off and pay it next year, I don't see how that's going to work, but I might be wrong on that. This is just so you know, today's presentation is just what we know now. There's still a lot of ambiguity out there. There's still a lot of unanswered questions. So somebody might have a better answer to this, and I'd be happy to hear it, but I wouldn't take that chance. I would say calculate what you want to pay and do it now. And then somebody else is responded here and says that I tried and the plan won't let us change our plan. So that's kind of interesting. especially on a match. And then there was another question, does payroll to a part-time employee qualify for forgiveness? And yes, all of your employees would count, and we'll talk a little bit more about the full-time equivalency and how you account for everybody when we talk this through. So I think Erin Allen is the one that said here, I tried and the plan won't let us change our plan. So I think maybe we need to look into that a little bit more. So why don't we just leave it as it is right now, and here's another one. What if I make profit sharing contributions annually, but I make the whole payment for 2019 during the 8-week period? Do I have to prorate? And here's another question that I don't think it's clear. So if you're making and I have heard people say they're going to do this. They're going to make the 2019 contribution and they're going to do it during that 8-week period, and they're going to try to get that to be forgivable. It might work because at least you're paying it on behalf of the employees during that time. Judy, I don't know if you have an opinion on that.
Yeah, well, just a warning on that is that you might want to talk to your TPA, because if it's a high level plan, you may be limited as to what you can actually contribute based on what the actual salaries end up being for 2020, which is an unknown. So I know with one of my clients, we calculated what the contribution would be through June 30th, which we felt comfortable with, and then have them pay half of it. I mean, you know.
Yeah, I think in this question, they're talking about paying for 2019. So they already know what the salaries were for 2019. They're taking the deduction on their 2019 tax return, and then they're funding the plan in 2020, which is allowed, and you're allowed to do up until the extended due date of the tax return. And so, and I've seen this question come up quite a bit, where can you treat the amounts paid for that in that time period? And you know, I don't think it's 100% clear from what I've read. I think you probably have a chance of getting that because at least it's going in on behalf of employees, but the amount clearly was incurred in a prior year tax return. So I think until further clarification comes out on that, I don't know the answer entirely. But you know, we'll look into that a little bit more, and as we hear things, we'll let you know.
And one more question came in, is vacation pay included in the $100,000 limit? The answer to that is yes. Okay, how does the loan forgiveness work? High level, we're going to be going in through the calculations, but obviously you have to spend the loan proceeds in order to have the forgiveness, have them eligible for forgiveness. Non-payroll costs must be paid or incurred during the covered period. And this is from the small typing in the actual application, where payroll costs eligible for forgiveness are paid and incurred during the covered period or the alternative payroll covered period.
So I'd like to comment there, Judy, and this kind of goes along with what we were just talking about on the retirement plan, because retirement plan is considered a payroll cost. Payroll cost, the way and I spent a lot of time looking at the rule. There's a rule out there right now. It's called the Interim Final Rule, 85 FR 20811. You know, you can go on the web and pull it up if you'd like. And it goes into greater detail about the rules on what goes on to the application. And for payroll, they say in general, payroll costs paid or incurred during the 8 consecutive week, 56-day covered period are eligible for forgiveness. And so that's right there. And then they have these options for using an alternative payroll period or the regular covered period. The regular covered period is the day you receive the loan proceeds, counting out to 56 days. It's an 8-week period starting on the day you get the money. The alternative payroll period is meant for administrative convenience, and from what we can tell from reading the application, it's available to payers who pay biweekly or more frequent payrolls. So if you read that literally, and that's also in the rule, it's kind of suggesting that you can't use it if you're a semi-monthly payer. You pay twice a month, or if you pay by the month, you can't use this alternative method. Anyway, the alternative method, what that does is that requires that your covered period for payroll purposes changes, and it starts on the first day of the first pay period that happens or occurs right after you get your loan proceeds. And so then your covered period changes slightly. And they did that for administrative purposes so that, let's say you're a biweekly payroll and you decide to use the alternative payroll covered period, then your period wouldn't start till, let's say you get your loan on April 1 and you have a pay period that's ending on April 4 and you're paying the payroll on that day, then you would not be able to include that. You'd have to wait till your first pay period that started after April 1, and then that would be the beginning of your pay period covered. And for the ending, they've made an exception to the general rule of paid and incurred, and they've said you can prorate that last pay period to make sure that you get it, even though the amount might be paid right outside of the covered period, as long as it's in the next regularly scheduled payroll. And so this is a little bit ambiguous because the SBA has been clear on breaking the rule on the back end of the payroll, but they have not been, meaning that you can pay it even though it was incurred prior to the covered period and you're paying it after your covered period is over. But they're silent on the front end. And so what I find a little odd about this, first of all, I think they're going to have to come out with guidance because everybody's all over the map on this. A lot of organizations and businesses are thinking that as long as I pay it during the covered period, it doesn't matter if it was for the pay period prior to the covered period, I get to take the whole thing. And there's a lot of people that say, I don't think I can do that. And so all I'm going to say is this, the SBA has been clear that for self-employed people and for partners in partnerships and for owner employees, it's a maximum of 8 weeks. That's all you're getting during that time period. And they've been clear in the alternative payroll period that you're getting a maximum of 8 weeks. And they say throughout that they think that in the rules, they say that they feel the alternative pay period would be comparable to the covered period. And so there's a disconnect there, because if you do it during the covered period and you're not following the alternative payroll period rules, then there's a question. You know, it looks like you can use your first payroll during the pay period, even though it was incurred previously. I think this needs clarification. And so otherwise it's going to be done both ways. Some people are going to go ahead and use that first pay period, even though it was for paying for payroll prior, and others are going to be more conservative and they're not going to. This may all become moot, though. I'll end on that note. It might become moot if Congress changes the 8 weeks and extends it. So I think until further guidance comes out, we're not sure about the answer to this, and we got another month probably before people are going to be applying for forgiveness and completing the application. So I'm just going to stop there, Judy. I didn't mean to take over, but this is confusing, and I think it does address this retirement issue as well.
Yeah.
Because
I'm just going to add on page 2 of the loan forgiveness application, under both eligible payroll costs as well as non-payroll costs, it does clearly state that costs were both paid and incurred only once. So it's under both of those, it says you can only claim that cost once. So that does help to at least clarify a little bit there. Okay, with regard to the spending limit, here's an example. Borrower receives a $100,000 PPP loan and spends $50,000 on payroll costs and $30,000 on non-payroll costs. The loan forgiveness is limited to the $66,667, which is $50,000 divided by 0.75. This is a pretty draconian cliff, if you will. So it's important when you're going through, and if you want to use that Excel-based spreadsheet that we have on our website, you can actually play around with this, because you'll see that by putting more in payroll costs, ultimately it will work itself through and allow a lot more of your non-payroll costs. How does the loan forgiveness work? There's 2 reductions, which Pat's going to be going through with examples, but you know, there is the salary hourly wage reduction. It basically means that you can't have more than 25% reduction in your salaries, and you use your covered period or alternative covered period, and you basically compare that to what your salaries and wages were during January 1 through March 31. And we do have an example of that. In terms of the full-time equivalent, it's maintenance of the level of staff. There are exceptions in a safe harbor, and we have an example of that as well. The application itself, this is the information you need to gather in order to complete the application, and it's going to be on page 1, which is basically the next page. Here's an example, and with Pat, Pat's going to be going over starting from here.
Okay, thanks, Judy. So we're not going to go through the application. As you can tell, we're already past a half hour into this presentation. And I don't know if you've looked at the application, the 11 pages, but there's a little small print on it that says it takes 180 minutes to complete, including gathering all information. Well, that is ludicrous, because this thing does not take it takes 180 minutes to read it, and still you're questioning whether or not what you read makes sense. So we're not going to go through it, but I want to show you, because basically it's important to see what it looks like. So it's basically a couple of pages. This is the first page with the numbers, and the second page involves questions that you're going to answer, certifying that everything is the truth, that what you're presenting, in the face of prison or fine. So it's a very important thing to do correctly. But you see, it asks for a lot of information, including loan numbers. It asks for the employees at the time of the loan application, employees at time of forgiveness, the numbers, and so you just take that off your payroll. It asks you for the amount you got for the EIDL, $10,000 advance if you got that. And you're not going to subtract it on the application, but the SBA presumably will when the time comes. It asks you for payroll schedule, the frequency of your payroll, and you check one of those boxes. And here again, I think you're checking that. And if you check biweekly or weekly, it allows you to use the alternative method. If you check twice a month, which is semi-monthly, or monthly, you're not going to be able to. So that's my opinion from what I've read. It asks you for the covered period and the alternative covered period if applicable. So if you choose to use the alternative covered period, if it works better for you, you can put that in there. That's your administrative convenience. If you work it through and it doesn't work better for you, then by all means don't use it. Just use your covered period. And then it asks a very important box. Check this box if the borrower together with affiliates, if applicable, receive the PP loan in excess of $2 million. Really important. Don't check the box if you have a loan for $1.5 million. You don't want to check that box. Only if it's in excess. Actually, if the loan is $2 million, you don't check it. It's if in excess of $2 million, then you check it. And presumably anybody with $2 million above is probably going to get audited. Whether or not they audit everything and come out to your place of business to audit you, nobody knows that. If you give enough information when you submit your application and it's very clear and detailed and all your documentation is there, including your documentation, I'll remind everybody of why you needed the loan, why it was important to you at the time of the crisis, you felt you needed that loan. If you have really good documentation, which you should be doing right now, documenting, if you give everything, it might be that they look at that and don't come knocking at your door and they'll be satisfied with the audit of the paperwork you've turned in. I don't know that. We don't know that. They can also look at organizations that get less than $2 million. We think it's unlikely going to spend a lot of time doing that, but they can. They've left that open for themselves. And then if you look, there's about 11 lines that go down. Line 11 exactly is the forgiveness amount at the bottom. The first part is the payroll and non-payroll cost, and the first line is payroll cost. And remember, payroll costs include retirement and health benefits as well. And then it's the non-payroll cost after that, which is lines 2, 3, and 4, which include mortgage, interest, rent, utilities. And then we start with the reductions, and we'll get a little bit more into that. But I want to point out something here. Line 5, the first reduction is the salary and wage reduction. And that's going to be an actual dollar amount if you had reductions greater than 75% of the payroll. So if you didn't, or greater than 25%, I should say, if you did not have any reductions in any of your employees where their payroll went more than 25% below what they were making prior to 215, and there's a couple of different exceptions here. If you didn't have that, you don't even have to worry about this. You're not going to have a number that goes in there. But if you did, and you had, let's say you had some employees that went below more than 25%, but others only went 10%, it's only going to be the ones that went below by more than 25%. So they give you that range. As long as you're paying your people 75% of what they were making, you're going to be okay. And so there'll be nothing there. But this is on an employee by employee basis. You're going to have to do this calculation for everyone. And so I pointed out because it's going to be the first item that will come out. And then you add everything up, and then you multiply by the full-time equivalent quotient reducer, if there is one. And so the first one was the wages, and that came off at the top. And the second one is, did you have less people working for you based on a full-time equivalent? So if you had 5 people working for you prior, and you have 5 people working for you during the COVID period, you're okay. This won't apply to you. You'll end up with a 1, and you'll multiply it out, and you'll get full forgiveness, assuming you spent all your money, all of your loan proceeds, in accordance with the rules, 75% for payroll and 25% for other, or more than 75% for payroll. That you're allowed to spend more than that. And so it's kind of important because I think the full-time equivalent reduction is more severe than the salary or wage reduction, just because it ends up getting multiplied by everything in the end. So I wanted to point that out. And then finally, you use the smaller of the numbers. So you look at your payroll costs, 75% can't be less than that. And then you look at the modified total after you multiply by the multiplier. And then you look at the PPP amount. And your forgiveness is going to be the lower of those 3 amounts. And that's what goes on line 11. So this is the key to everything. Now, there is let's go to the next slide, Judy. There is a Ppp Schedule A that summarizes these numbers in more detail. And this also is included with your application when you submit it. All of the numbers on this slide and the next slide are going to flow into the application. So that's what the point of this is. It's going to, you're going to calculate everything here, and then it's going to flow in. And further to that, let's go to the next slide, Judy. And that is slide 17. Here's the Ppp Schedule A worksheet. So you get 3 things all flowing in. The worksheet helps you complete Ppp Schedule A, and Ppp Schedule A is the summary of everything that's going to flow into the application. So that's the way it's going to work. So you're really going to start from here. You're going to start from here, and this is where you're going to look at, and it's 2 different calculations. One of them is going to be for all employees with cash compensation eligible for forgiveness that are earning less than the $100,000. And so those people are going to be in the first list. And the second list, you're going to break out the employees that are $100,000 or more, because you're only really looking for the reductions here in the $100,000 list. And in the under 100,000 list. So those are the people you're going to have to do employee by employee, listing it all out, what the cash compensation was, what their full-time equivalency is, and if there's a reduction, then you're going to put it in that box 3 reduction. And let's say you have 5 employees and 2 of them have reductions, and you've calculated the amount, which we'll do. There's a slide that'll show how that's calculated later. Then you'll add up those 2 employees, and that'll be in box 3. Let's say you have no reductions, then that'll be 0 in box 3, and you won't have any reductions. So that's how that slide will work. So now let's go to slide 18. And so now we'll talk a little bit about the wage reductions and the FTEs. So an FTE, you need to calculate what your full-time equivalent is. And this was not defined earlier. It's been defined in the recent information that came out on 5/15. And so you have to determine, the base is 40 hours. And so everybody who works 40 hours, if that's your normal work week, is 40 hours is a 1. That's 1 equivalent to a full-time employee. And then part-time employees, which are allowed, are rounded to the nearest 10th. And the maximum value for any employee is 1. So let's say you have a part-time employee, to keep this simple, that works half-time, 20 hours, there would be a 0.5. If you have somebody who works 28 hours, they would be I think it's a 0.7. We'll get to that in a second because we have an example, but they would be another point. So this is first, you have to figure this part out. One of the questions I know I've gotten before is, what if we have a 35 or a 37.5-hour work week? Then you're okay because you're going to be comparing apples to apples. If you had a 35 or a 37-hour work week prior to this and you still have that work week, then as long as you're treating everybody based on 35 hours divided by 40, you're going to get the same quotient and it's going to work on both sides. It would be Pat, if you had go ahead.
Yeah, so one of the questions is, are holiday, sick, and vacation hours included in the full-time equivalent calculation?
Holiday, sick, yes, they would be. All hours that you're paying for. So
right, and they even said in the rules that if you happen to have a furloughed employee, their hours would be, that you're paying, their hours would be included based on what their normal schedule would have been.
Right, even if they're not working.
Right.
So, we always pay for vacation and sick leave, and if you're an salaried employee, the salary just remains the same, and you just note that they used up some of their vacation. That would be included here, so you wouldn't change that.
And there's another question, is an owner considered an employee?
Well, we'll talk about that, and I think we address it in other slides, but why don't we get to it right now? Owner employees are treated differently. So you have to account for that. And if you're an employee in a PC and you're an owner, you would be treated as an owner employee. And so I believe that in that case, you're limited, and this is in the rules, you're limited to the 100,000 max, and you're limited to 2019 compensation. So I'm looking at, and this is in the rules, in particular, the rule that just came out, owner employees are capped by the amount of their 2019 employee cash compensation and employer retirement and healthcare contributions made on their behalf. Schedule C filers are capped at their own owner compensation replacement, and general partners are capped at the amount of their 2019 for Schedule C, and general partners are capped at 2009 net earnings. So if you're an LLC filing as a partnership, that would be a general partner there, and you'd be capped at the 2019 earnings. Where I come out a little different on this is that between the owner employees in a PC, for instance, compared to the Schedule Cs and the partners, is that I believe that it says here, no additional forgiveness is provided for retirement and health insurance contributions for self-employed individuals, including Schedule C filers and general partners, as such expenses are paid out of their net self-employment income. I don't see where they mention, and I'm looking in the rules here, so that's not in the application itself. I don't see where they mention owner employees of a PC there. So I would say, and Judy, you can disagree with me if you'd like here, I would say that if you're an owner employee in a PC corporation, then you would be allowed, you have to cap the compensation at 100,000, but you would be allowed to allocate the retirement and healthcare benefits on their behalf and include it in the payroll cost.
That's what I read as well. Yes, okay. That's right.
So we're in agreement
it's
on that.
Capped at the 100,000, where the non-owner employees, the amount of the retirement contributions and health insurance is in addition to the 100,000. So they are treated differently.
Right. So
another question here, Pat, is what if we have hourly employees who work different hours each week?
I think you have to, you're going to annualize them because you're going to do the schedule for all of the pay periods that you have, and you're going to come up with annualized numbers. I think for those kinds of questions, you have to go through the math on this. You have to add everything up to come up with what your total average hours are for the 8-week period compared to total average hours for the base period that you're comparing it to.
Right.
So that's what I think happens there.
And the last question is, are 1099s included in payroll costs? And again, no. 1099 are contractors. They're not considered employees.
Yeah, so that question just keeps coming up. I'm not quite sure why. So let's make clear we understand what a 1099 is. If you're paying a consultant and you give them a 1099, you're a company, you're a business, you have employees, you have yourself, and you're also paying consultants, and contractors, and you give them a 1099 at the end of the year, you cannot include them. That's not employee payroll. These have to be employees that are on your employee payroll, or for yourself, you're a self-employed person, you receive 1099s from people you do business for. Well, that's your income. So you treat yourself as your own self-employed, and you can go up to the maximum of 100,000 per annum, which is 15,385 for the 8-week period. So let's move to the next slide, because I want to stay on this issue with the...
This is the next slide, yeah.
Okay, sorry. So here, you're allowed to use an alternative calculation for the 40-hour work week, for the coming up with the full-time equivalents. And so if you want, you can say everybody who works 40 hours or above 40 hours will be a 1, a full-time equivalent. And anybody who works below 40 hours, could be 30, could be 35, could be 5, could be 20, would be a 0.5. And this is the simplified alternative calculation if you want to use it. So let's show you how it works, because I think you're going to see that you're going to want to do the math. And on a lot of these things we're telling you, I hate to tell you folks, but you're going to have to do the math. And if you need help, you got to reach out and ask for professionals to help you. We're available to do that. But this application is complicated, but the most important thing is you got to sit down and spend, according to the SBA, 180 minutes doing it. I would say you got to sit down and plan a couple of days, maybe a week, depending on who you are, to do the work. But anyway, this next example shows you how it works with the full-time equivalents and why you might want to do it both ways. So here you got an example of 5 people. I'll go through it quick in a company, and 2 of them average 20 hours a week, and the other 3 are 45, 40, and 28. Okay, if you do it the regular way, without the alternative method, you look at the first column, you're going to cap 40 is capped at, 45 is capped at 40, so that's a 1. They could be working 70 hours, and it would be a 1. The 40 is a 1. The 28 is 0.7. 28 divided by 40 is 0.7. And then the 20s are both 0.5, because that's the math. You come up with an average of 3.7 FTEs. Look at the alternative method, the same group of people. You come up with an average of 3.5 if you use the alternative method. So you're still capped at 1, 1, and then anybody below 40 is an automatic 0.5. That's a simplified method, the alternative method. You end up with 3.5. Now you might say, oh, well then it's clear you got to use the regular method. I would say no, because what if you had your last 2 employees were 10 hours? Or the last 3 employees were 10 or 15 hours or something different and lower? It might not come out the same. So you got to do the math in order to determine what's best. That's all I'm going to say there. Go to the next slide, and here we have, so there are some safe harbors for full-time equivalents. We've had a lot of questions on this. If somebody has left and you have made, they left because of COVID, and you cleaned up the office, got it all ready, you made a good faith offer to rehire them at their regular pay during the covered period, and they say, no, I'm afraid to leave my house, I'm not going to work. Then you've made a good faith effort, so they would not count as a reduction in your full-time equivalent. You'd be able to give them a 1. Okay, same thing with indicate employees that were fired for cause, voluntarily resigned, took another job, moved, whatever, or decided to retire early because of the pandemic, okay? Voluntarily requested a reduction of hours. You won't be hurt by that. You can treat those people for purposes of the test as a full-time equivalent, or at least as a partial, if they were half-time, you'd be able to treat them as a half-time, whatever they were before. So you only mark, this is important, you only mark exceptions in these positions if it was not filled by a new employee. So let's say somebody voluntarily resigned and they were in an important position, so you had to hire somebody right away, and you were able to hire somebody right away to cover that position. You can't also include both. You could include the new hire, but you would not use the safe harbor for the person who left. So you don't get double dips there. So this is kind of important, but there are safe harbors. The key here is documentation. You got to have everything in writing here. So if you wrote a letter to somebody and you didn't keep a copy of it, and you can't prove that you made an offer for them to come back to work in a safe environment and they turned you down, then you're not going to be able to use this. You have to have everything documented in order to use these safe harbors. So moving on here, we go to the next slide, and this is the hourly and wage reduction. So this applies for employees who did not receive annualized rate of pay of more than 100,000 during 2019. Okay, so that's who you're doing this calculation on, and you're doing it one by one per employee, and you're comparing it to the base period, the look back period, which is January 1, 2020 to March 31, 2020. So you have a required reduction if the reduction in wages over the 8-week period of your covered period or your alternative covered period is in excess of 25% of the total salaries or wages of the employee during the look back period, which is the first quarter of 2020. So first you're looking at 2019 and then you're looking at 2020. So you're doing it for people what they were paid in 19. If they're in that category, you do the calculation and you do it using the look back period. So now we have an example. And this is important because if you remember going back to the slide that showed the application, and I said this is the first reduction that comes off your total. So you have your payroll and you have your non-payroll costs, you add it all up, and then you have to reduce it by the salary or hourly wage reductions. That's the first one. This isn't the FTE reduction. This is the first one. So you look how it works. You got John's salary is $52,000 during the covered period, okay, 8 weeks. He was making, prior to that, in the first part of 2020, he was making $80K a year, and you had to reduce his salary because of the crisis and because of COVID-19. You had to give him a reduction. So automatically you do the math on that, 52 divided by 80 is 65%. You're clearly above 25. You've reduced his salary below 75%, more than 25%. You've actually reduced it by 35%. So, and I forget what not applicable reduction is required. Oh, I guess you didn't meet the 75%, so it's reductions required. So now you figure out, how do I calculate the reduction? Then you take his $80,000, the original salary, and you multiply it by 75%. So had you paid John $60K, to put it in English, had you paid him $60K during that 8-week period, you would not have had a reduction. Even though you reduced his salary to $60K, it wasn't below 75% of what he was making before. So you would not have to do this calculation. But because you reduced his salary to $52,000, you've got a reduction. So you take the $60,000, not the $80,000. You take the 75% minus the 52, you come up with $8K. Well, $8K is not your reduction because that's for a whole annualized salary for the year. So to come up with a specific reduction for the 8-week period, you divide by 52, multiply by 8, and it's $1,230 is related to the reduction for John's salary. You're going to do this for everybody. Everybody that's making $100,000, under $100,000 in your organization. And if you end up at the end of the day with nobody that went below that 75, then your reduction is 0. If you end up with some people that were reduced or everybody, you add up the total and that's your reduction. Okay, so the next slide, salary reduction potentially avoided. So a lot of these pits and falls that you hit, there's a way out of them if you can get to one of the safe harbors. So let's say you determine the annual salary and wages as of, you determine it as of February 15th, 2020. That's a date that's kind of important here. And then you determine the annual salary from the period February 15th, 2020 to April 26th. And if step 2 is greater than step 1, then the safe harbor doesn't apply and you have to move to the next, we'll move to the next slide here. And then you determine the annual salary and hourly wages for the employee as of June 30th, 2020, which has not occurred yet. We're not there. We're in June 2nd, I think, today. So come June 30, you have an opportunity here. If you've reduced wages, you can avoid having that haircut of the $1,200 we just calculated on the other page. If you rehire that person, if you get that person back up to their salary by June 30th, 2020. So if that amount is equal to or above step 1, you've got a safe harbor and you met it. So come June, we still have this opportunity coming forward is what I'm saying, coming up with June 30. So this gives the employees relief as long as the employee compensation is restored to the February 15th level by June 30. So you might question, what level am I restoring to? They give you a very specific date here. It has to be February 15th. So you go to the pay period that included February 15th, and if you restored their payroll to that level on February 15th, by June 30, you have a safe harbor and you don't have to take that haircut. during.
Quick question, Pat. One person said, I read if you meet the full-time equivalent test, you don't have to go through the salary reduction calculation. And that is not correct. The salary reduction calculation comes first. If you remember, we went back to the application. That's the first haircut. And then you go and you might have another haircut based on the FTE.
And you might recall that prior to, I think, May 15th, when they came out with the application, nobody knew the order of how the test was going to work, the wage reduction or the FTE reduction. And when the application came out, it became clear what the order was. You do the salary and wage reduction first, and then the FTE after that. So you have to still do both.
We're rapidly running out of time, so.
Okay, so the next slide here, the amount paid to owner employees, self-employed individuals, this is capped at $15,385, or the 8-week equivalent of applicable compensation for 2019. Very important here. If the owner employee was making less than $100,000 in 2019, you're going to be limited to the 2019 amount. It's the lesser of, but it cannot be more than $15,385, which is basically $100,000 divided by 52 times 8. That's what that is. General partners are capped at the amount of 2,000 net earnings from self-employment, reduced by the Section 179 expense and the unreimbursement expenses that they may take. So you get a K-1 if you're a general partner. Usually shows your income on a separate line from the deduction that you receive for depreciation via Section 179. That's just an expense. You have to net those two. And then you sometimes further take additional deductions on Schedule E when you put your K-1 on your tax return for unreimbursed expenses. You have to account for that as well. Let's go to the next slide. We'll try to get through our slides and then we'll see if we can take any more questions. So here's a really good example, I think. We had people that went out and put in for their loan, PPP loan. When they did it, they took $100,000, which is what they were making in 2019 or now, and they said, I'm dividing that by 12 and multiplying by 2.5, which is what you were allowed to do. And so they got their loan of $20,833. And so now we're finding that this is for a sole proprietor or single member LLC or a partner in a partnership. We're finding that the maximum loan compensation, owner compensation, can be forgiven is $15,385, which is $100,000 divided by 12 times 8. So now you have the difference of your loan of $20,833 minus the $15,385. That difference, the maximum amount, is $5,449. That can be used for non-payroll expenses, and that's okay. You can use the loan for non-payroll expenses, but forgivable expenses that are used are limited to the 75% rule. So I think in this case, you're only going to be forgiven for $5,128 of the $5,449 that you've used from the loan because of the 75% rule, because you can't go more than 75% of payroll. And so that, I think, is going to be a surprise to some people. And it's not a bad thing so much as that a couple of $100 you won't be forgiven. You'll owe it back to them. That's my understanding and my interpretation on this.
And just so you know, there is that denominator under maximum owner compensation. It should be 52 times 8. That's a typo. But you do the math. 100,000 divided by 52 weeks times 8 weeks is 15,385.
I see that,
Yeah.
Judy. I didn't catch that earlier as well.
Yeah.
So then what's the next slide?
Here we go.
Okay. So now real quickly, on May 27th, just recently, a few days ago, it was on a Friday, the House passed a bill. It's called the Ppp Flexibility Act. There was a vote of 417 to 1. So I guess they meant for that to pass. I don't know who the one person was. Senate is expected to take something up this week. That's what we've heard. And I have read a couple of things that the senators are in agreement with most of these things. I think I saw that it might have been Marco Rubio said that on the 24-week, I think they were thinking about, the Senate was thinking 18 weeks. But anyway, they're talking about changing the 8-week covered period to 24 weeks, which would spread it out, which would make a lot of our questions here moot because it's going to change so dramatically. They're also talking about changing the 75-25% rule to a ratio of 60-40, possibly, which would make that last slide moot, because the problem there was the 75% rule stopping that self-employed person from getting their full PPP loan forgiven. So that could change. They're talking about the Safe Harbor FTE deadline extension. This is a huge one, from June 30 to December 31. of 2020. So what does that tell you? That kind of tells you that your loan application for forgiveness might not even be being prepared until next year in 21, after you've had an opportunity to restore all of your employees back to the payroll level that they were before. So that's kind of an interesting one. It'll might extend the time to pay the loan, repay the loan from 2 to 5 years. That's a big thing. And it also might allow payroll deferral for PPP borrowers that receive loan forgiveness. If you recall, there's a payroll tax deferral where you don't have to pay the payroll taxes in immediately. You're able to defer them. And I forget exactly what the dates are on that. We don't need to go into it. But you were not allowed to do that if you received forgiveness for your PPP loan. They're talking about changing that. So stay tuned on that because it might make this whole presentation moot. That's all I'm going to say on that. This last slide talks about documentation. Can't say enough about it. If you're not keeping good documentation now, you ought to start doing it. You're going to need it to fill out the application, but you're also going to need to submit it to the bank to get loan forgiveness. You're going to sign in the application, you're going to sign a statement that says, I've submitted to the lender the required documentation, verifying payroll costs, the existence of obligations of service as applicable as of February 15th, and eligible business mortgage interest payments, yada, yada, yada. They're going to want all of this documentation and more. And the documentation is listed out in the application. And the bottom line is anything you use to come up with a number on your application, I would consider that documentation. So it's going to include definitely payroll reports, payroll tax forms. It's probably going to include bank statements that showed a proof of payment of the ACH transfer or the check date of the payment. Not only for payroll, but for lease payments and utilities. You're also going to have to show lease agreements for cars, personal property, storage space, rented space for your lease. You're going to have to provide all that, a copy of a mortgage statement. So all of this is going to be required documentation. And you're also going to have to document, remember, the reasons why you took the loan to begin with, if it's more than $2 million. So, and maybe you should have that even if it's less than, just because they're allowed to look at that if they want to. So all of this documentation is going to be very important.
Just to add to that, the SBA can audit these loans. You're required to keep this information for 6 years.
That's right. Even the stuff you don't turn in. So you remember we told you you don't turn in the worksheet for Schedule A PPP. You don't turn in the worksheet, but you have to keep it for 6 years. So, you know, you're going to have to hang on to all of this stuff for 6 years. I don't know if we have time for any more questions or if there are any that we haven't answered.
Well, there's one that says, I see a lot about June 30th as the key date, but if your 8-week period expires on June 12th, can you use that as the relevant date for employees? For example, can an employer lay off employees on June 15th and still get full forgiveness if the 8-week period expired on June 11th, or do you need to keep those employees through June 30th?
That's a good question, and I saw it come in earlier. I thought I'd done a response to it, but I don't know the answer entirely, but my guess would be shooting from the hip that you would be able to do something like that because you've satisfied the 8-week covered period.
Yeah, so I was going to say the first thing you want to do is look at your FTE and what did it end up being? If you were at 1, then it doesn't really matter. If the quotient is negative and is really reducing the amount of your loan, then you may want to be careful and just keep on until the 30th. But
yeah, exactly. So you don't want to. If you were good point, Judy. If you were taking advantage of hiring people back on June 30, you don't want to do this. However, if you've met all of your requirements for the 8-week period, I don't think the SBA or Congress or anyone else is telling people how to run their business after this time period is over. So you might find that you have too many employees at some point later on and you need to reduce them. I haven't seen anything, and maybe if somebody has, they can share it. I haven't seen anything that says on June 30th, you have to have everybody in place if you've met all the other requirements. So if your time period ends on June 12th and you have definitely met all of the requirements for the forgiveness during that 8-week period, it might be okay. There is a point, though. There is a question, remember, on the application that at the time of the application for forgiveness, how many employees did you have? I don't know why they're asking that question. So that could be something that could come up. So if you do reduce your employees at the time you apply, I don't know if it would affect you. I don't know. Could it affect you if you're more than 2 million, if you're under 2 million? I don't know if I haven't seen an answer to that question.
And I think we have time for just one more question. I just put the slide. One person asked if we could display the slide again for where our website is, and also that very important worksheet, Excel-driven worksheet that'll help you go through the math. But we also have a question on line 7, FTE on the loan forgiveness application. How do you get a 1 if there's only a self-employed Schedule C taxpayer with no other employees? I think the answer to that is it's assumed
Automatic.
it's a 1.
It's assumed, yeah.
Yeah.
Yeah. Assuming that.
Is it possible to ask a question if you're on the phone?
I'm fine with it.
Let me just interject really quickly, though, for the person who'd like to ask a question. We are recording this. We are keeping the chat box information anonymous. So just be aware, though, if you're asking a question, during the meeting like this, that your question will be recorded.
Okay, that's fine. Is it possible for me? Can I go ahead and ask?
Sure.
So just a clarification, if you received the loan on April, I'll give you exact dates, April 24th, and you paid semi-monthly, so your first payroll where you used the monies was on the April 30th payroll, but you paid, that covered the period from April 15th through the 30th. Can you take that entire amount, even though technically some of what you're paying was for the period before you received the loan, but it's actually paid after you received the loan?
Okay, so we did talk about that earlier, and it depends.
Right.
If you're using the alternative method, the answer would be no.
You can't. Yeah, you can't use that. We can't use that. So
Okay, if you're not if you're using the regular method, I see people that are doing that right now, and they're intending to take that, and I think further guidance is needed because the SBA has been silent on the front end of the loan, the first pay period, on whether a proration is required. They don't talk about it at all. It's not mentioned. They talk about proration on the final pay period at the end of the 8-week period, but they don't talk about it on the beginning. And so a lot of people are interpreting that to say that if you paid, as long as you paid it during the 8-week period, you can take it and use the PPP loans for it. I've seen other people, and I've been on webinars where other people are advising that you can't. You have to prorate it and only account for the part that was incurred during the 8-week period. And so,
and that's kind of my take, is that it defines in the application, it says paid equals the date of disbursement, incurred equals the date earned. And then it says you can only apply for forgiveness for that paid and incurred. So I take the more, I think, a conservative answer on that, and that you would prorate that portion of the payroll.
And I would agree with that. It is the more conservative way to do this because clearly the spirit of the discussion and the law was to cover 8 weeks of pay, incurred and paid. And if you use the alternative method, or you're self-employed or you're a general partner, you're clearly limited to 8 weeks of pay. So in every other scenario, you're limited to the 8 weeks. But the rules are a little ambiguous. I will say that for sure. So I understand why some people are reading them and taking the position that as long as it was paid during that 8-week period, you're okay. And if no further guidance comes out on this, I'm sure that a bunch of businesses are going to be taking that as part of their PPP loan forgiveness application. Because without further guidance, it's very ambiguous and very unclear, I think. But I think I'm in Judy's camp. Conservatively, I would go the other way without further guidance, just to make sure no questions came up on forgiveness. But if you need it to make the numbers work, it's your call. You might want to seek counsel and get other people's opinions on that. I think there'll be more guidance, and I think they're going to end up changing the 8-week period anyway, so it might not matter when it's all said and done.
We're 10 minutes over the meeting, so we probably should wrap it up. I just wanted to point out We are holding 3 more sessions, one for nonprofits, one for small businesses, and one for automobile dealerships on the 4th, 9th, and 10th. Every day we're going to be checking for updates, so tune in if you can to one of these other seminars, and maybe you can get a further update on that. And then the last slide, of course, is how to reach myself and Pat, and our email addresses along with the phone number. If we can be of assistance in answering other of your questions, we certainly would be happy to do so. And thank you very much for participating. We enjoyed being able to have the opportunity to present today.
Yep, thanks everyone, and stay safe. Be careful out there.
Okay, bye-bye.
All right, see ya.